anytime I'm meeting with advisors, high net worth, RIA type firms, I always say, like, lean into these resources. If you're investing in their mutual funds, their ETFs, any of their investment strategies, you're probably paying a management fee or expense ratio of some sort. Like, so if you are investing in their strategies, why not use the resources that are available to you free of cost, essentially? Why not lean into that expertise? These are people, I mean, the team that I was on at Invesco, we're doing this day in and day out, and we're excited to partner with our advisors.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to episode 9 of The Bull of Wall Street. I am Jimmy Lee, the CEO of the Wealth Consulting Group, and with me are my co-hosts, Talley Léger, our Chief Market Strategist, and Jim Worden, our Chief Investment Officer. And we have a special guest right next to me, Paisley Nardini. And I'm super excited about today's podcast because I get to interview our host as well as our special guest, Paisley, who's a consultant to our investment committee. And, I'm more excited about today's podcast than I have been about the other 8 previous ones, because I want all advisors that are listening in and anybody else to get to know more about our team here. And I want to start out with Paisley and have her just start out with really, where you grew up and tell us a little about your career and things like that.
Well, thank you guys for inviting me to episode 9. I think I'm joining for episode 10 as well. And I hope your prior podcast guests are not listening to this one when you said this one is by far your favorite. But I am really grateful also to have the opportunity to join you guys on the investment committee. Before I jump into my background, I think a great takeaway, anyone that's listening to this that is in the advisory capacity, running at their own investment committee at an RIA or broker dealer, having outside thought leadership, that cognitive diversity from other people's viewpoints, backgrounds, I think is instrumental. So the fact that you've invited me as an outside resource just really speaks to your guys' desire to grow the business, be better, and invite all kind of backgrounds into the process. So my background, I'm in Southern California now. I've been here for about 10 or 15 years, but born and raised in Minnesota. I went to school up in northern Minnesota, Duluth, University of Minnesota, Duluth. And I had an interesting college experience in the fact that I actually was going to go into forensic sciences. I think I watched one too many CSI episodes in my day and said, wow, this looks super fun. And so took my criminology courses, my sociology courses, and then had to take chem class. And I knew after my first class, this was not going to be for me. So I had to pivot in about sophomore year and somehow landed up in a financial markets program where we had the opportunity to manage some of the endowment for the University of Minnesota as an undergrad. So was pitching individual stocks from like a sector perspective. I was covering the consumer staples sector. I think just flashback, I think we went long Walgreens, short CVS in 2011. So if you guys want to pull that up on screen. I actually don't think it worked out very well, but that's not the point. The point is we got amazing experience, and that's what drove me to be in this industry. So graduated with financial markets degree and a psychology minor and moved out to San Francisco. And that's where I got my career started. And I think what's also really interesting is, especially when you're going through college coursework, like thinking about potential career paths, like everyone wants to be in investment banking. Everybody wants to be in portfolio management or trading. But they don't really fully understand or grasp like the diversity of career paths that one can take. And I'll share more later about some of the work I do with undergrad university students today. But I ended up joining the industry as a short-term bond trader, was in the institutional world, I think it was like my third or fourth week on the job. I was like trading a couple billion in overnight like treasury bills and repo collateral, which at the time I didn't really understand the gravity of. But to look back and think about how amazing that experience was out of school. But yeah, that's just a quick rundown. I've been in California ever since, and happy to share more on my career path.
So we're actually sitting at the PIMCO building. Talley and I are at the PIMCO conference here in Newport Beach. Paisley lives down the street. Jim's at home, where he usually shoots his video up near Sacramento. And so PIMCO actually used to be your employer, right?
Correct.
For a little bit. But I met Paisley when she was at Invesco. We're actually, that's where I also met Talley. You guys were both colleagues there.
Getting the band back together.
Yeah. And we'll get into Talley and Jim here in a minute. But Paisley, your experience in the business, now you're managing director at Simplify.
I am, yes.
And a portfolio manager. I remember when you were at Invesco, you were working with the asset allocation team.
Yep.
Tell us a little bit about your experience with that.
Yeah. So as I mentioned, started my career in fixed income and realized that there was more to the pie than just bonds, and especially just front end bonds, which after a couple of years, especially in like the ZIRP policy, the zero interest rate policy post GFC, fighting with like some of our sales coverage for overnight repo to get it at 1/8 of 1 basis point. I mean, again, didn't even comprehend at the time right out of school, like what that actually meant. So I knew there was more to the puzzle. I knew I had a big career ahead of me. So I expanded kind of my experience into more of an all asset class, right? So how do you think about equities, bonds, diversifiers, alternatives, and how those come together? Because at the end of the day, and you guys see this at Wealth Consulting Group, like when you're working with your clients, typically they're invested in multiple asset classes. And I think that's a really valuable skill set. So one that I really built at my time at Invesco, where I was working with our clients on asset allocation, portfolio construction, risk optimization, like how do all these pieces come together and how do we ultimately build portfolios that help our clients achieve what their objectives are, whether it's income, capital appreciation, diversification, risk mitigation. So that was really the skill set that I built up at my time at Invesco, working with a lot of advisors such as Jimmy, and thinking about like how can we optimize our portfolios. I think we're always trying to improve for our clients' sake, trying to save on fees where possible, of course, too. So spent several years really kind of getting into the weeds with both high net worth advisor as well as institutional asset owners on how do you optimize those portfolios. So that skill set is one that I've now brought over to Simplify, where I'm supporting our multi-asset opportunities, helping build out our model business, and kind of the same effect of what I was doing at Invesco, with just more in the diversifiers and alternative space here at Simplify.
Awesome. Talley, I'm going to go to you next so you can unmute. Tally's sitting outside the conference room. He took one for the team because we were echoing on the podcast. But if Dan Ives can walk around Manhattan and take selfies with people, Talley can do this too. Talley, where'd you grow up? Were you an East Coast guy?
More of an Eastern Canada guy. I grew up in Toronto, Ontario. So in that part of the country, they say Léger. But where my dad's from, Montreal, Quebec, they say Léger. So, no one can say that. So I'll take Léger. That's close enough.
And I knew that Talley was Canadian. I just keep teasing him that he's a New Yorker because he lives close by now. But Talley, you've had a long career. I think you were, also on the circuit with Invesco at the time, on the research side, talking to a lot of people like us, doing keynote speeches and so forth. I was always impressed with the way that you communicated about the macro and economics and so forth. So you and I always kept in touch through our good buddy Alex at Invesco. Yep. And unfortunately, we were able to convince you to join our team. But can you go back to your career with, all the stuff going back to your days at ISI? I think as I saw both you and Jim's LinkedIn profiles, you guys both had a little stint in sales as a financial advisor, right? That was your first gig. So tell us a little bit.
Well, so I graduated in 2000, which was a very difficult market environment. The NASDAQ, I believe, peaked in March of 2000, and I graduated in September. So no one was getting any jobs. So I thought it was a fantastic opportunity. I thought I was so lucky to get a job as a financial advisor in the private client group at Morgan Stanley. And, we did the national sales training. And by the way, for recruiting purposes, I still kept in touch with a lot of those guys, but we'll circle back on that one. But it was a great way to learn the products, get the training. That's where I learned how to hustle, to be honest. And I know we're competing with audio here. There's a bunch of conversations going on. But I was actually putting money to work in the marketplace, managing portfolios, taking risks at a very young age. And I think few opportunities would offer you something like that in markets. And today I always cherish that experience, and I've kind of brought it full circle because now the advisors are my audience. And
Hey, Talley.
Yeah.
Why don't you jump into the conference room next door, and then when you get kicked out, you can jump back out before you move on to the next part of your story. Let's get back to you here in a second. Once you get into that conference room, Jim, I'm going to switch to you now.
Sure.
I'm going to go right back to Talley here in a second when he gets in that conference room. Is it open, Talley?
No. Can you hear me? They took it already.
Oh, shoot. Sorry. Okay. Forget it. Let's keep it going. I like this very raw cut of the Bull of Wall Street.
We're real here, people.
Yeah.
Someone just asked me for my autograph. That's what that was.
There you go.
Yeah.
So
I signed their forehead.
So you started out as a financial advisor. How did you get into research and doing what you do now?
So I did that for a couple of years. Didn't do too bad. I raised $10 million and I got the National Directors Award. And I passed the book off to my partner. I knew I wasn't going to be doing that for too long because my real passion was in economics and research. But by the way, my father was a professor. He taught economics at Queen's University up in Canada for many, many years. So that's where that interest comes from in me. And I actually got a job, my first research job at Brown Brothers Harriman in New York. I went to school in Boston, and that's where I embarked on this strategy and economics path, and just never looked back. And I've been doing it for about 25 years now, but the first half was all sell side, starting with Brown Brothers, and that was institutional strategy research. You mentioned ISI, a big bank like Barclays. It was Lehman. So man, that was an experience. But we were fortunate. They purchased us, and we kept our jobs. And I ran my own shop for a little while, Macrovision Research.
Yeah.
And I went through Krishna Mamani's office at Oppenheimer Funds at the halfway mark. And he's like, well, why don't you just come and do this for us full time? And that's now the second half of my career on the buy side. So, it's financial services sector, Jimmy, as you know. So Oppenheimer got purchased by Invesco, and that's where I got to meet Paisley and Alex Shard and all my friends there. It's nice, as Paisley said, it's kind of like getting the old band back together here. And meeting great clients like you, Jimmy, over the years, just engaging with our partners in the field. And the audience is so broad. When you work for a $2 trillion asset manager, you just get to meet everybody. And this side of the business is great.
Well, I'm looking forward to letting our advisors that don't know you personally get to know you a lot better, at our conferences and all the meetings that we do like this. Alex tells a funny story. He said that one of the times that
Alex tells a lot of funny stories.
The story about Talley coming to speak at some big event that Alex put on for his advisors, clients, or his whatever it was. And he said Talley shows up and he's got these like a suntan thing where he's got goggles on. For those of you that don't know, Talley is a big skier. So he actually went skiing before this conference.
Same thing happened.
Yeah, apparently it was a lot sunnier because he showed up very tanned.
Yeah, I am. I got some color. Actually, Jim, I was up near your way. I was in Tahoe.
You were?
Not too far.
Lake Tahoe, beautiful.
Yeah.
And last but not least, the gracious Jim Worden. So Jim, I was very thankful to meet you through a mutual friend of ours who's also a wholesaler. I mean, we do a lot of work with wholesalers at the different asset management firms. I think they're great partners of ours for introduction to advisors, but also just people in the industry, and of course their products that they distribute. But Jim, tell us a little bit about how you grew up, where you grew up, how you got in the investment business. I know you also started out as an advisor yourself, and then like Talley, switched gears and got more into research and portfolio management.
Yeah, so I grew up in a very, very tiny town, probably population 2,000 or 3,000. So a little town called Camino. It's on the highway going toward Lake Tahoe, and they're known for apples and apple treats and apple donuts and Christmas tree farms. So went to a small town there. My brother actually was a missionary in Korea. After he came back from his mission, he got a job working for a guy doing import-export business in Korea and in Hong Kong. And so when I went to college, before I went to college, I went to BYU. Before I went to BYU, I went to the Philippines as a missionary, came back to snow, decided I did not want to go to Provo because it's just too cold there. So I went to BYU, Hawaii. And I thought that that's what I wanted to do was import-export. They had a good import-export program there. So I majored in international business management. And so while I'm in school, I kind of fell in love with the idea of doing like management consulting, strategic management. Like I thought, well, that's what I want to do. So I kind of changed my mind, as many people do when they go to school. And so coming out of college, graduated in 98, and all these management consulting places like Bain and McKinsey, well, they wanted people from Harvard and Yale and Stanford. So I was married at the time, and I'm like, well, I gotta just find a job. And so I applied lots of places, and there was a couple wirehouses that I was interviewing with, and I settled on taking a job with Prudential Beige Securities. And so worked there in the wirehouses, did lots of cold calls. So started as an advisor, did that for about a year, and I didn't get a ton of clients. It was just talking to lots of people. I was very young, like Talley. And then I ended up moving to Wells Fargo and was a advisor there. And, I just didn't, I just realized that the sales thing, it didn't work out. I was more interested in the portfolios and investment management. So then I worked for a hedge fund, actually doing research. That was kind of a short gig, but it was super good experience. He was a technical guy, small hedge fund. And then September 11th happened, and that just didn't work out. And so good experience though. And then I went to work for a small broker dealer that was also an RIA, started in compliance and just got my foot in the door. And then I started working with the TAMP, and then I started managing the money there. And that company was sold to an insurance company, and then the insurance company sold it to another broker dealer, and then that broker dealer sold it again. So we went through all kinds of crazy turnover and went from 75 people down to 4 of us. So it wasn't big like Invesco, but it was 75 people felt like a decent size.
You're talking about Securities
company,
America, right, Jim?
What's
America?
that?
Securities America?
Securities America bought us, and then they sold us to Ladenburg Thalmann, and they absorbed the broker dealer. And so we were the RIA that was left over. And then that was sold to Ladenburg. And then I worked for Allworth Financial, which used to be Hanson McLean. ran the money for them, built a bunch of models for them. And and so then I ended up here and love it. I mean, absolutely love it. On that journey, I did the CFA, and it's not because I'm smart. It's because I'm stubborn, and it's because I have a little bit of grit. So I got it done, and then when I finished that, I was like, I have all this time on my hands. I've always wanted to learn about technicals and about alternatives. So I did the CMT, which is the Chartered Market Technician, and then I did the CAIA, which is the Chartered Alternative Investment Analyst, which Paisley is familiar with. So I just wanted to get those done, and so now here I am. But love what I do, and it's been quite a journey.
Well, Paisley also is a CFA.
Yeah.
Are you also a CAIA too?
I am a CAIA as well.
Yeah,
and little alphabet soup.
And she just came from her local CFA. Was it board meeting?
Yeah, Orange County board meeting. I've been on the board of the CFA Society here in Orange County since 2016. I want to say I stepped in as president last July, and I serve a 2-year term. But I've been heavily involved with the CFA Society of Orange County for about a decade now. And if any of you are connected with me on LinkedIn, I apologize because I post a lot about the CFA Society. But I mean, similar to Jim, I'd say I'm also quite stubborn in the sense when I set my mind to something, I will get it done. When I entered the industry, I didn't really have a choice on taking the CFA exam. It was essentially demanded of me, and I'm very grateful for that. Had it not been something I was expected to do, I don't know if I would have taken it on. And I would suggest anyone that is considering the CFA exam, do it as early as possible in your career, because once you have a real life with kids and family and other obligations, trying to find time to study for it is nearly impossible. But I attribute it to much of my network. When I moved from San Francisco, where I started my career, down to Orange County, I had zero network down here. And so to now say I'm the president of the CFA Society, I think really speaks to the amount of effort and energy I've put into building the network, staying involved in the CFA Society. And again, really grateful for the network I've built from that.
Yeah, and we're really fortunate to have you helping us with our investment committee, which this podcast is primarily intended for advisors to listen to, and I think one of the things that as an advisor my entire career, I always felt insecure, running the money. And what happens, I think, in an advisor career is that initially when you start in the business, you look for other money managers or third-party, asset management platforms typically, because you don't know what you're doing. And then all of us think we're Warren Buffett at some point in our careers. So we start running our own money. And then quite naturally, if you're able to make it as an advisor and you're successful, meaning like you have a lot of clients and you're earning good income eventually at some point, you may not be spending as much time behind the screens, right? Looking at data and research that CFAs and macroeconomists and other people do. And so I always thought it was unfair, really, to our clients to not have a full-time team running the assets. So today, one of the things I'm really proud of is that at the company we've got the three of you that are instrumental in the process that we use. But as you guys know, we also look to, on a formal basis, some of the big managers that we work with, including PIMCO. We're here at the meeting today, but they'll be doing our next quarterly formal review. I know that Paisley did one when she was at Invesco for us, and so we use other firms, big firms like that. And the consulting arms of those companies help us with our process, right, Jim? In terms of what we're putting into the portfolios on a daily basis, and what you guys do behind the scenes while advisors are doing their thing, working with clients and trying to get new clients. So
just on that point, anytime I'm meeting with advisors, high net worth, RIA type firms, I always say, lean into these resources. If you're investing in their mutual funds, their ETFs, any of their investment strategies, you're probably paying a management fee or expense ratio of some sort. So if you are investing in their strategies, why not use the resources that are available to you free of cost, essentially? Why not lean into that expertise? These are people, the team that I was on Invesco, we're doing this day in and day out, and we're excited to partner with our advisors. And so by tapping into those resources, you're essentially getting it for free. And I think just speaking earlier to what you were saying is the relationships that you build through these relationships, through these wholesalers, there's so much that you can pull out of that I think a lot of advisors are afraid to ask, or they don't even fully understand like the bench of capabilities and expertise behind them. And these firms, whether it's Invesco or BlackRock or PIMCO or Simplify, we're so eager to spend time with advisors and to help build portfolios and take that investment lift off of them so that they can focus on building relationships and planning and tax expertise. So I think that's something I've just seen firsthand as the one who's always offering it. Very rarely do you get taken up on that. So I think you guys have done a tremendous job of tapping into your partners to get some of that expertise to lighten your load, really.
Yeah, it's probably good timing for me to plug Paul Kim, who's the CEO of Simplify, your boss.
Yes.
For allowing you to participate with us. And he's a good friend of mine. He also used to be a PIMCO portfolio manager and strategist and creator and stuff. And so anyway,
shout out to Paul.
Yeah. So I'm just very proud of the process that we have and the talent and, the three of you. And Talley, going back to you for the next question I've got is, you've been in the business a long time, doing research. You know a lot of people, in the research world. One of the things that I know that has been perplexing to a lot of economists and advisors is why we didn't fall into a recession recently, right? Because everybody was predicting a recession. I know you were not, though. You and some of your friends like Neil Dutta, you guys were predicting that the market would continue to, or the economy would continue to expand, and that assets like equities would continue to grow, and stock prices would go up. And as you heard me ask one of the PMs here, who's a very big name, why the economists were wrong. What can you tell the advisors? Why were a lot of the economists that are really, some people still thinking we're going to get a recession soon? I don't want to name any names, but why were they so wrong, Talley?
Well, I would say a lot of the pundits are kind of classically, traditionally trained, like myself, and we relied pretty dogmatically on indicators like the misleading indicator. I wrote about this recently, actually, Jimmy. I put a flash out about this.
Yeah.
And in hindsight, and look, it was a nervous call and it was wildly unpopular. But as you know, Jimmy, I tend to make those kinds of statements. And thanks for putting up with me. But I think the conference board has some explaining to do. The leading economic index, and I tried to kind of flesh this out in the note. It's highly manufacturing sensitive. And the manufacturing sector in the U.S. is still struggling. It's mired in a recession. And that's important because the business cycle hasn't disappeared, but it's been hollowed out since the 1970s. So it's a much smaller share of the U.S. economy now than it was back then. And the services side of the economy, and that's the lion's share of GDP, is relatively robust. So I think that's kind of a simple way of answering your question. But I diverted from the House view in November of 2022, and that was another kind of sweaty moment from me. But I had that was Alessio versus Talley, and yeah.
Well, so I got to pick sides.
Yeah. Well, I had the cover, Paisley, as you know, of thankfully a culture known for its diversity of thought. So I was allowed to kind of depart from the House view. Having said that, it didn't get the support of the marketing department and the deep wallets that they have for promotion, because there's a business that they've got to promote. So, but I gave out my 5 reasons why I thought the October 22 lows would hold. We talked about this, Jim, remember, with Russ Kostrich just the other week. And that's another great episode you guys should tune into. But the first, and I'm a markets guy first and foremost. I do try and connect the dots between the macro and the markets. But look, as we know, and I like to point out, markets get ahead of the economy. So and that by the way is, I think, one of the reasons why it's a component. The stock market is a component of the leading economic index. But my first reason was peak fear. And I think cyclically, Jimmy, or tactically, there is, I think, a good amount of bullishness right here. And we've been kind of waving a yellow flag tactically on that score. But structurally, I'm still seeing a lot of fear. And Jim and I talk about this all the time. And this is, we laid it out in the outlook. There's $7 trillion sitting on the sidelines in money market funds, and that's just the tip of the iceberg. So I think there's probably more to come when we talk about this bull market.
That's great. And that's one of the things that resonated with me when you were on stage at one of our conferences years ago, that you did connect the dots from macro to, the market and what sectors or what should do better and what advisors could be paying attention to. And by the way, we love Alessio. We're hoping to have him on one of our podcasts soon, right?
Can I join?
Future.
Great guy.
We'd love to have that. So we love Alessio and we love the firm. Jim, I'm going to switch gears to you so you can talk a little bit about, from an investment committee perspective, which I really, of course, Jim is our chief investment officer, is in charge of the portfolios, but I really am proud to have a process. And I always talk to Jim about that if something happened to him, he got hit by a Mack truck or whatever, that the process would be able to continue, for the clients, right, for the investors and advisors. And so, that being said, though, what's our view now? Can you talk about what sectors we favor? What do you think is going to happen 2025 and beyond?
Yeah. So first of all, I just have to say, I don't know why it's always a truck or a bus, but but it could be anything, right? It could be a tree falling. But yes, we do have a process that's very, very detailed, very disciplined. And I'm just, by the way, I'm thrilled to have both Paisley and Talley, both of them, on the committee, because this is like a huge upgrade. I feel like, not that the committee prior to them was bad, it was great, but like it's an improvement. So
boy, it's good.
Just more thought leadership.
Yep.
But what I was going to say is, like, the sectors we continue to like technology. We continue to like industrials. We have an overweight in real estate and staples. We're kind of at this juncture where we're reviewing the technicals. We're reviewing the macro. And so Talley and I are staying in touch on the macro, and we're looking at fundamentals. And so really, ideally, we want to find sectors, we want to find companies that are in the intersection of good macro tailwinds. Fundamentals are not crazy off the charts expensive, and then the technicals can support that. And so those are the positions that we have now. Those positions can change. There's some portions of the portfolios that we run that are sleeves. So we look at those independently. And as you mentioned, Jimmy, we talked to some of the largest firms on Wall Street. So we talked to Goldman Sachs, to Invesco, to JP Morgan, to all of these firms, and kind of digest their inputs and their analysis, and that goes into our process as well. So those are the sectors that we're looking at that we like. I would say with this new year, new government, I'm excited. I think that there's more to like than to not like. The potential for lower regulation means lower costs for companies. To the degree that we have inflation continuing to come down, that's good for margins. And if rates come down, we've seen rates come down a little bit. I think they'll come down some more. That will be good. And then, of course, let's not forget AI and everything around AI and productivity that can increase margins. And I think that's going to be very, very healthy for the economy long term. Having said that, I do think that there's going to be some areas eventually that we will see some disruption. And disruption, frankly, it can be very exciting, but it can be kind of scary too, because that means that there's certain areas that are going to change. With the labor market, certain areas are going to not be needed as much. And then there's going to be new areas. There's going to be new jobs that are created and new industries and new sectors. So I'm just really excited. I'm still bullish. We've had a little bit of volatility this last month, but I still think we can do really well. And, the S&P can hit 7,000 this year.
I was talking to one of our advisors recently about another large asset management firm where they have a CIO and a couple of deputy CIOs and a chief market person, and the CEO is very, out there as well. And they go around the country speaking together, and they have different views. Like right now, on a very popular chief economist, it's famous, and I was telling the advisor about that story, and the advisor was like, "Well, geez, that's confusing, and we got to come out with the same message." And I'm going back to what you were saying, Talley. I actually believe, one of our guiding principles at the firm at the leadership level is being diverse. And that's also in thought, right? Having different views, not having a groupthink type of a mentality. And so obviously we have to communicate well and consistently to our advisors to help support what they do. But in terms of differences of opinions or thought, I think having lively, debates is a good thing, right? To come out with the best outcomes, and then having a process to, determine what that is, I think is really important. So that being said, Talley, you and Paisley, you guys can freeform a little bit, and Jim also, in terms of what you like this year. What are you guys thinking about the markets, macro in general? Are you bullish?
Yeah, I'm happy to jump in.
Go ahead.
I would echo a lot of what Jim just shared in regards to being bullish. I think investors and markets broadly are looking for a catalyst to sell off, simply because the current market feels like it's extended. It's long in the tooth. Valuations are full. We've never seen value underperform growth. We've never seen the equal weight underperform market cap this much. And I think given some of the catalysts that Jim just mentioned, whether it be AI and growth and technology, and as Talley mentioned, moving to more of the service sector versus manufacturing, like that really sets markets up for a different catalyst for the next, 5 to 10 years on what propels us higher. I think heading into this year, and I was fortunate when I was in New York in December to join NASDAQ for an interview and share my thoughts on, and that still stands today despite some of the recent volatility, which, by the way, in order to see active return, you have to have active risk. There has to be some sort of healthy volatility in the marketplace. So zero or extremely low volatility should be a warning sign to everyone. So what we've seen the last couple of weeks, I think, is markets digesting some of that euphoria in early fourth quarter. So I'm cool with that. Let's just say that. But as we come into this year, I think there's expectations for a lot of factors at play to cause further volatility. There's a lot of uncertainty, and we know markets do not like uncertainty. So whether the new administration follows through on a lot of these promises or beliefs that tariffs at any certain level, deregulation, crypto, all of these things are reasons that the rug could get pulled out from under us, and maybe they don't come to fruition. And so because of that, coming into this year, keeping your chips on the table, but thinking about ways to be prudent when you are taking active risk. So again, maybe biased because of where I sit at Simplify, but really thinking about risk mitigation strategies across your multi-asset portfolio and ways to kind of cut those tails. So seeking additional risk premia, return premia outside of equities, going into alternatives. If we look back at 2022, I think that was a really great wake-up call for a lot of people. There was this rise of passive investing, and I think a lot of very large institutional asset owners as well became really comfortable and complacent with just throw it into passive. Give it to me at 2 basis points, 3 basis points. I won't lose sleep at night. I don't have to think about it. Well, 2022 happened, and all of a sudden people woke up and they said, oh, yikes. I guess if markets are going to go down and we're passively invested, we experience that full drawdown. So heading into this year again, just to kind of bring it full circle, how do you stay in the market? Because I think there's a lot of bullish reasons to remain invested, but just be a little bit more thoughtful at kind of cutting some of those tails and thinking about drawdown risk and how can you incorporate diversified sources of risk and return. So, in the alternative space, whether it's long, short, whether you're looking at managed futures, additional sources of alternative income, and also like looking at convexity strategies. That's something Simplify has a lot of experience in as well. So just really thinking outside the box and building more sophisticated portfolios that a lot of our institutional asset allocators globally have done for decades. I think that's now really just coming to the advisory space with the proliferation of product availability and a lot of new strategies that are innovative coming to market.
Hey, Talley, I'm going to buy you an expensive tequila tonight because I know you're holding your phone there.
His arms getting sore.
Not much longer. Not much longer. Well, let me just jump in there if I could.
Yeah, and feel free to walk around the building if you want. I don't want to keep it, but anyway, go ahead, please.
I have to go to the bathroom. Can I bring you guys with me?
Go ahead.
Well, so I like the way we characterized or framed the outlook. The title I gave our strategy in pictures was, U.S. still the best house in a bad neighborhood for now. And by the way, Jim, we share a lot of the same views with PIMCO. And for the record, we published first. So, but they called it the best or the cleanest dirty shirt. It's a similar kind of metaphor, which I've heard before, but I still like it. But I think in the near term, in the portfolio section and the positioning section of the outlook, another kind of subtitle I gave it was tactical defense, strategic offense, right? So the defensive plays, I think, are basically captured by the title. So in the near term, it's a concept of flight to safety and quality flows in a global environment that's basically falling apart. And so the expression of that from a market's perspective is dollar-denominated assets should kind of maintain their buoyancy. And, U.S. large-cap growthy tech stocks are in the crosshairs of all those forces. And so that's basically what we're seeing. And I think we timed the tactical. I know no one's perfect at timing the market, but the clouds and the here and now and the market turbulence, I think we've done right by our clients and our advisors. But looking past the near term kind of doom and gloom, the U.S. is the obvious bright spot on the canvas there. I would say the biggest surprise, if I had to make a bet, I'm not a betting man, but if I had to make a bet, I think it's going to be international markets. And the thing that we really have to watch and monitor here, and we talk about it all the time, is the US dollar. So it really has to turn. And I think back to the time when I was the global equity strategist at Oppenheimer Funds during Trump 1.0. And, I guess this is for the history buffs. It's not that long ago, but emerging markets in China had some banner years during Trump 1.0. So it's not that crazy. And the U.S. play on those same Chinese themes would be materials stocks. And by the way, last time I looked, the Chinese manufacturing PMI was actually back in expansion territory. So I think we could be positioning ourselves pretty soon for a melt up in those areas of the market, playing some offense then instead of the defense right now.
That's a very contrarian view that you're, and which I love actually. That maybe more intermediate term, dollar goes down and international security is a little bit better, right? Yep. I know that obviously all the people that are in that asset management business on that side have been praying for the dollar to go down and for the earnings over there to be better, and they've been touting the valuation story for years now. Jim, what do you think? What's something you're watching out for as far as risk? What do you think could happen that could blow this up?
Oh, risk. Well, so Tally mentioned melt up. I think the melt up is one of the risks if things just get a little bit too euphoric. I don't know if you guys saw that Trump had his meme coin and Melania had her meme coin. So things like that worry me a little bit if there's too many dollars chasing assets like that, and if the markets do a redux of 2021, that was not a good look. So that worries me. I would say World War III worries me. That's hard to model. You don't know how that's going to work out, and as long as we can steer clear of that, I think we're good. The other thing that is probably the biggest concern, it hasn't materialized. Surprisingly, it hasn't materialized at all in the last couple of years, but it's I would say it's liquidity within fixed income. We saw during the pandemic that was very problematic and contributed a lot of volatility. And so the last time I was out there in PIMCO last year, I asked one of their group CIO about liquidity, and he had a very long, elaborate answer about how PIMCO really works hard to be in positions that are highly liquid. They're constantly monitoring what they own, and it's not about just owning these things, but how do you get out? We're a little bit different environment now post the great financial crisis, where we had some intermediaries with banks that were more intermediaries with fixed income. Now it's just between asset managers, and so I do worry about large institutions being in the same trades with regard to fixed income.
I would maybe add to, just on the topic of fixed income and having that contrarian view. I think investors really got caught off sides in the back half of last year. We saw that through interest rate volatility in bond markets and expectations for rates to go lower. They did the exact opposite. And now there seems to be this kind of broader consensus, I would say, that rates are going to be higher for longer and inflation is sticky. And so I think that's one of the kind of more immediate risks in the market, is if we start to see inflation, as you guys I think you've even alluded to, be less sticky than consensus is pointing to, and we start to see inflation come down and maybe rates recalibrate along with that. I think a lot of people have given up on bonds, and so then the expectation of rates don't stay higher for longer, and now people have missed the trade as duration rallies. I still haven't quite come to terms with that contrarian view. I think that could be an immediate risk, especially for portfolios where advisors have said, you know what, bonds have not served me since mid 2022. I'm out. Right at that crux of when we might see a rally in interest rates.
But what you're saying is really risk to the investor or advisor that's not positioned properly,
Yes.
not necessarily the markets, because because that's what I wanted to talk about, because that's my personal opinion. My personal opinion is in alignment with, let's say, Jim Paulson's, or actually even Mr. Kiesel here. He just spoke.
Yeah.
And, my personal opinion is that inflation is going to be lower than what's predicted, and that the Fed's going to move more, which means that I think our portfolios are positioned that way in the committee, Jim, to an extent.
Yeah.
But
and that's a contrarian call for many.
Yeah, and I think I'd love to have you guys chime in on rates. What do you guys think with inflation and rates? I mean, if there's one thing that I agreed with Kathy Wood on, right, of the famous ARC products and funds, is that she was now talking about she was more worried about slow growth, than about high inflation over the longer term, which that's the camp that I've been in. And of course, inflation has been sticky up until recently. And I know there's some other folks that we've interviewed, like Neil, that think that inflation is going to come down more as well. But what do you guys think about rates? Talley, what do you think?
I'll chime in. So that was actually one of the similarities I noticed in the talks here at the PIMCO ETF Summit. And I wrote about this recently, talking about self-reinforcing virtuous cycle. But I just leaned on a measure I found on the New York Fed's website. They talk about multivariate trend inflation. it's a fancy concept, but basically, the PCE price deflator, according to their model, and they decompose it and they look at the underlying trend. But it's 2.3%. Let's not quibble about 0.3. It's basically right. It's basically in line with the Fed's 2% inflation target, and the key forces I think underpinning that trend are coming from housing, and we talk about that. Housing's under pressure right here, and that's the component that had been stubbornly kind of sticky, as we're saying. So that's coming down. Goods are helping as well. So I think that we're probably going to get some more cuts, and I'd be leaning into bonds here. I'd be surprise, surprise, PIMCO likes bonds too. But I think we like both bonds and stocks. They probably prefer bonds over stocks right here.
And Talley, just to, I think, confirm maybe what you were getting at is looking at within PCE, shelter being a key component of that. And like the new rents coming in have seen a pretty meaningful decrease. And I think it was Powell who came out and made comment of this, of like the imputed prices versus the new rents. And so kind of that dislocation and looking at the right data points. And so maybe a lot of people at the inner circle are already kind of aware, which is why they kept moving forward with a lot of the rate cuts into the year end. But yeah, I think as long as we keep following the dot plot and looking at that as kind of the Bible, I think we'll continue to see interest rate volatility rather than like looking at the data ourselves and being thoughtful about where we are from a rate level as well. And I would say too, I mean, inflation can continue to come down and still be elevated versus what we're used to over the last, 10 or 15 years. So maybe it's not 1.5, maybe it's 2 to 3% over the next couple of years and fluctuates. I think that's healthy. Kind of going back to my earlier comment of like having healthy kind of volatility within markets. And I think being above, Fed has even said that 2% is an average. It's very unlikely that we're going to just rest, fly the plane, rest nicely on this soft landing of 2% and sit there for the next 5 to 10 years. So again, going back to Jim's comments of feeling bullish coming into this year, things don't look so bad.
And why do you guys think, I think this is a good explanation, or not explanation, but a good question for a lot of advisors to understand better. After the Fed cuts 50 bips in September, why does the 10-year go up so much? Jim, I know you've been talking about this, that obviously investors got way ahead of themselves on that trade, but can you talk about that?
Yeah, so I think a lot of this has to go back to expectations for the future and like the labor market. So we did go through a period where the labor market softened more than what the markets were thinking it would, and then we also had stronger labor market, and so we have been kind of in this strange funk where bad news is good news and good news is bad news. In other words, like if the job market number is too good, then people worry, oh no, well, the Fed's not going to cut rates, or they're not going to cut as much as we thought they were going to cut. And so that still exists. I think I will say this, and I agree with what you said, Paisley, about the housing market and rents. We got to a period where multifamily was overbuilt. There was an excess supply of multifamily and too much building, and now you've got, by the way, and Russ Kosterich mentioned this in the podcast that we had before, you got this migration of people that are moving out of California. They're moving to places like Texas and Tennessee and Arizona. So you have that. But I would say just recently, I've been saying, I feel like the labor market is softening, but just the recent mandate for government employees to go back to work, we'll probably see a little bit of turnover there where people decide they want to go somewhere else. Some people will go back to work, but we'll probably see some turnover. That's probably going to impact the labor market. And I would certainly say that ongoing investment into AI over time is going to have, it's going to weigh on the labor market some. So my call is still 3 to 5 rate cuts this year.
Wow, I love it.
And it's pretty common for the curve to uninvert and for the back end to move higher as the front end starts to cut rates, right? Because remembering the rate cuts are focused on the front end of the curve, and we've been inverted curve environment since mid 2022, which has been really unhealthy for a lot of markets. If you think about that funding rate being at the front end of the curve, and that's been higher than where you could invest along the curve, hasn't been a lot of opportunity. So I actually think the backup and the uninversion of the curve now having this kind of, it's still relatively flat, don't get me wrong, so it's all relative, but if we can see the curve uninvert further and be a little bit steeper, there's a lot of opportunities from carry trade, from FX currency, and a lot of really attractive kind of funding opportunities for banks and investment opportunities as well. So I think a little bit of that is continued to be healthy. So if the front end does see some more cuts this year, that just bolsters the case for more market activity, in my opinion.
Can I just jump in? Because
one second, Talley. Hold on one second.
I have an answer to your question, Jimmy.
Well, I'm going to get to you. Hold on. 5 cuts. That's almost as aggressive as your 6,000 on S&P 500 last year call in February, Jim.
Yeah. Yeah, it is.
Right now.
Well, and the other thing too, I think one of the reasons why rates have been so high in the longer end is just because there's some concern about deficit spending.
That's the answer.
There's you got a wall of maturities that we're going to have to refinance some of that debt. I don't know. I feel like some of the forces with, this new Department of Government Efficiency, it's not going to be as bad. Like, they're still going to spend money. There's still going to be some investments, but it's, long term, I think is a positive that, the deficit spending does get somewhat under control.
All right, Talley, tell us.
No, that was it. I mean, it took us, what was that, a 20-minute answer? Why did rates back up so much in response to the first Fed cut? Well, it was fiscal concerns. Short and sweet.
Okay. What do you think the Fed's going to do? Where do you see inflation? What do you think about rates a year from now?
Well, the inflation answer is the same. We already talked about that. But the way you frame the conversation, and I did this recently for a segment. We have 8 meetings on the calendar for this year. We never expected to get 8 cuts, but we think 0 to 1 at some point the market, it's been oscillating around. We didn't think that was an outcome, so you just split the difference. Simple answer.
So
if I could just add too, just last September, the markets were thinking we were going to get 10 cuts.
Yeah. And
we went from 10 cuts all the way over to 1 cut or less. And so I think that, again, the pendulum just swung too far. We're going to get 3 to 5.
Well, it's interesting because I recall when we're interviewing Paulson, and he was talking about the Fed, in his opinion, just being absolutely wrong, right? This last couple of years entirely. And we know that the Fed futures market has been not so accurate itself, right? I think they're predicting the dot plots kind of to a degree. But anyway, anything else that you guys want to talk about when it comes to markets? Or I'm going to finish up with asking you some personal questions. But anything else about the market that you want to talk about before we jump off to a different subject?
I'm good on my end.
No? Talley? No?
I'm good.
All right. Well, let's start with you, Talley. Besides skiing, what else do you like to do for fun? What do you want the listeners to know about you?
Oh, geez. I gotta be careful with my answers here.
It's okay.
Keep it family friendly, Talley.
Family friendly. So my wife likes to travel, so we try and do as much as we can on that score. That usually involves a ski trip. Sorry to always bring it back to skiing. I like working out. I spent a lot of the COVID pandemic years building a gym in our garage. So now you can't get a car in there. It's a gym. But yeah, kettlebell training and all this stuff. So that's all part of the experience.
On our leadership meetings, Talley's walking. and so he's got some sort of a routine that he could
At least
walk
he's not
on.
doing push-ups.
Yeah. Let's go to you,
Well,
Paisley.
the push-ups would be awkward, but standing desk with a walking pad, that's just fine.
Yeah.
Besides doing research, what do you like to do for fun?
So I always tell people I despise this question because it makes me realize I need more hobbies. So what I'm about to tell you is like, no one's going to be like, wow, she lives a fun life. So when I'm not working, I do spend a ton of time volunteering for the CFA Society. We have a student managed investment fund, which is quite similar to the program that I was in school. So we're giving these students like experiential learning, their ability to manage multi-asset portfolios with real money. There's mentorship opportunities. It's a year-round program. So like that just pulls at my heartstrings. So like that's my volunteer work on the side. But I like to tell people I'm kind of a house cat. And it shocks people when I say I'm actually very introverted. So at any point in time, like when I'm outside of work, like it's very likely that I'm at home. I also have like a home gym. I like to lay low. I love to cook. I'm not like a very fun, exciting person. Like I try to like make my brand appear to be exciting, but outside of work, I lay low for sure. I live by the beach, so I like to be outside a lot and go for walks. And yeah,
you're kind of a wine person too nowadays, aren't you?
I actually enjoy learning about wine. I think more than drinking wine, which very people would probably say that. I think I'm allergic to a lot of wine, which is why that's
good for you.
But yeah, I like to spend a lot of time up in the Central Coast and like Paso Robles area. So if you guys aren't familiar, hopefully many are, but it's kind of the up and coming Napa. It's the more approachable version of Napa from a cost perspective as well.
Well, Jim's right in wine country, but he doesn't drink wine either. Jim, how about you? What do you like to do for fun?
You know, I love being out in nature. I often will go walking around my house. There's a lake that's close. The American River runs right near where I live, and there's a little lake that two dams in between. So I'll walk around there, that area. Love to read. Spend time with my dogs and my family, and camping and hiking and doing things like that. Family history is something that I started doing probably a few years ago, and I've gotten more into that. Probably wouldn't recognize it, but like I have a little bit of Chinese in me and a little bit of Egyptian. So it's really neat that you can go with the data and AI. You can actually find out all kinds of things about like where your family's from, and so that's fascinating. I like this. Our church has a temple here close by, and I like to go there as often as possible. If I'm traveling and if there's a temple around, I'll go there as well. So pretty simple. Nothing wild.
And I know Jim's, for those of you that don't know, Jim's fluent in, is it Tagalog? Is that how you say it?
Tagalog.
Yeah. So for anybody out there that wants to invest with us, that needs to communicate in that language, we've got a white guy that can speak to you. Okay, I like that.
Well, and I studied Chinese in college, and I'm starting to study it again. So one new hobby is I started doing the Duolingo. So I've been doing that. So I'm on a streak right now, doing the Duolingo, trying to refresh my Mandarin.
Learn Korean so you can teach me more, because my Korean,
there you go.
My Korean's not so good anymore. But just in summary, then, in terms of the markets, what I get from all three of you is that you're positive or optimistic about the markets this year, both equities and fixed income, but still cautious, like everybody, right? So,
yeah.
Well, thank you guys.
Hers and his, three's company too. Come and dance on our floor. Take a step that is new.